found something really interesting.
The whole housing market is propped up on these bad loans.
The stock market is headed for a major nosedive on October 15. American investor and hedge fund manager Michael Burry predicts a huge crash in the upcoming month. Burry pulled off an impressive 186% return on his investments in the past 3 years. You might remember him as the main character in the movie The Big Short, where he made $100 million for himself and $725 million for his investors. But the real-life investor is just as smart as predicting stock market trends. If you want to learn about Michael Burry's bearish strategy for upcoming October 15th market turmoil, make sure to like this video and subscribe to the channel for more content like this. First off, Michael Burry's solid track record of beating the market. Over the past 3 years, the S&P 500, representing major companies, delivered a 25% return, and the Nasdaq, home to tech giants, managed an 18% return. But Michael Burry outshone them all with an incredible 186% return on his investments during the same period. How does he do it, you ask? Burry's secret lies in playing both sides of the market, buying when there's opportunity and shorting when he predicts trouble ahead. He became famous mainly because of his bold predictions, especially his famous bet against the market, immortalized in The Big Short. What sets him apart is his constant outperformance compared to the wider financial markets. But what's driving his massive bet against the American economy once again? Things seem to be looking good so far, right? Nope, let's dive in. Recently, Michael Burry has been making some rather interesting investment choices. But what's really caught our attention here is his investment portfolio, which amounts to nearly $1.6 billion. And he's done something interesting with it. He's taken short positions on underlying assets using put options. Now, you might be wondering, what in the world are put options? Well, make sure to like this video and subscribe to the channel first, and we'll explain. These options are directly tied to two major exchange-traded funds, the SPDR S&P 500 ETF Trust, known as SPY, and the Invesco QQQ Trust Series 1, referred to as QQQ. If those acronyms sound like a foreign language to you, don't worry, we'll break it down. Essentially, SPY and QQQ are like your windows into the big picture of how the US stock market is doing. They track the performance of two key indices, the S&P 500 and the Nasdaq 100 respectively. These indices are home to some of the biggest players in the various industries, and their performance gives us a pulse of what's happening in the market. Now, here's where things get really interesting with Burry's investment strategy. He's gone ahead and bought something called put options on these ETFs. Now, you might be wondering, what on earth are put options? Well, let me break it down for you. When Burry buys put options, he's essentially putting his money where his predictions are. It's like making a bet that the prices of these ETFs are going to take a nosedive in the near future. In simpler terms, he's saying, I've got a hunch that the market is heading for a downturn, and I'm making a move that could pay off big time if things indeed go south. Of course, this raises the big question that's on everyone's mind. What's behind Burry's perspective?
All the predictions of Michael Burry are coming true, one by one, just like the predictions of Nostradamus.
What does he know or foresee that the rest of us might be missing? Is he eyeing potential profits, or is he bracing himself for potential losses? These are the burning questions that have market analysts and enthusiasts confused. Burry isn't just bearish on the US stock market, he's also bearish on the tech sector. How is he expressing his bearish view? Well, he's employing a financial strategy known as put options. And let me break that down for you. Think of a put option as a financial safety net. It's a contract that lets the buyer sell an asset at a predetermined price, called the strike price, on or before a specific date known as the expiration date. Now, you might be wondering, why would anyone want to do this? Well, it's a way of making a bet that the value of that asset is going to decline. You're making a wager that the value of your house will decrease, and if it indeed drops, you can sell it for more than its current market value. But as with most financial maneuvers, it isn't a free ride. The buyer has to pay a premium, somewhat akin to an insurance fee, to the option seller or rider. If the price of the asset falls below the predetermined strike price minus that premium, then the buyer begins to see profits. However, if the asset's price remains above that level, or if the option expires without any value, it turns out to be a profitable situation for the sellers. Burry recently acquired a whopping 20,000 put options on a well-known exchange-traded fund known as SPY, which closely tracks the S&P 500. Additionally, he secured another 20,000 put options on QQQ, an ETF that's tied to the tech-heavy Nasdaq 100 index. Now, let's crunch some numbers. Burry's put options have reached a jaw-dropping total of $739 million. But what does that actually mean? Well, if he decides to put these options into action, in simpler terms, if he takes a bet on them and the market goes in the direction he's betting on, he could potentially cash in that eye-popping amount.
Given Burry's impressive track record of successful predictions during the 2008 financial crisis, 2021 inflation prediction, and the banking collapse of 2022 and 23, his market maneuvers are always intriguing for investors.
It's a daring move, and it's certainly sparking conversation. Is Burry predicting a market downturn, especially in the tech sector? Well, only time will reveal how these investments pan out and whether Burry's predictions turn out to be true. However, if we take a look at Michael Burry's track record, it suggests that his short bet could end up extremely profitable, especially if we consider history as a guide. Now, let's shift our focus to how we can align ourselves with Burry's investment philosophy. First and foremost, let's make something crystal clear. We're not going to suggest that you replicate Burry's trades by diving headfirst into short positions or buying put options. His specific options contract is quite complex and not exactly transparent, making it a rather tricky path to follow in his footsteps. However, for those who share his outlook and are searching for more accessible approaches, here are a couple of avenues worth considering. Get into something known as inverse ETFs. These can offer a practical way to potentially benefit from a market downturn without getting bogged down in complicated technicalities. The beauty of inverse ETFs lies in their design, as they aim to provide you with the exact opposite of the market's performance. Let me give you an example. Take the ProShares Short S&P 500, represented by the ticker symbol SH. It strives to mimic the inverse movements of the S&P 500. Similarly, there's the ProShares Ultra Short QQQ, with the ticker symbol QID, which endeavors to provide you with twice the opposite of the Nasdaq 100's daily changes. Now, what's the upside of going down this route? Well, you can invest in these ETFs just as easily as you would with regular stocks. There's no need to fret about premiums or interest rates. But let's not sugarcoat it, there are some downsides to be aware of. These inverse ETFs aren't designed for the long run, and they tend to lose value over time due to compounding effects and management fees. So if you opt for this approach, it's essential to keep a vigilant eye on these funds and make any necessary adjustments to align with your investment positions. Another savvy move to consider is diversification. You know, the classic don't put all your eggs in one basket approach. It serves as a safety net for your investments during market downturns, while opening doors to opportunities in various sectors and regions. How does it work? Well, it's about spreading your investments across assets that don't necessarily dance to the same tune as the US stock market or the tech sector. Think bonds, gold, commodities, foreign stocks, or alternative investments. Now, if the thought of diversifying your portfolio seems a bit scary, don't sweat it. There are helpful tools like asset allocation tools and robo-advisors at your disposal. These nifty assistants can guide you in building a well-rounded investment portfolio tailored to your risk tolerance and financial objectives. So, while following Burry's exact path may not be for everyone, there are certainly savvy strategies you can explore if you share this market outlook. Remember, in the world of investments, knowledge is power. Stay informed and invest wisely. And if this was helpful, make sure to like this video and subscribe to the channel where we bring you the latest investment updates.